There are basically 4 commercial, and so we're going to focus on the cash flow part first, one commercial. And there are 4 commercial cash flow formulas. And before I go into that, I just want to kind of go through the basic math and the numbers. So on all commercial property, this is the same whether we're talking about multifamily, industrial, retail, it's the same. The only thing that changes is the ratios and the percentages, but it's the same analysis. Standard CCIM evaluation method, Commercial Institute. Okay, they come up with the standard method. You take gross expected income. So if everything were rented in this, let's say it was an apartment building, and it had 10 units, and all 10 units were rented at market rent, what would that number be annually? We do everything annually. Okay? Then we subtract a vacancy factor that is consistent with similar properties in the submarket. Not what it historically is, not what it currently is. That's, both of those are mostly irrelevant. You want to know why it's not where it should be. But for calculation, we're looking at pro forma, or best case scenario. Okay? So we take what's typical for other buildings like it, and say, what's the average of them? If theirs is 5%, we use 5%, even though this building may be half empty. Does that make sense? We're not looking at it as is. We're looking at it as best case scenario. Okay? So we subtract the vacancy factor, and that will equal gross effective income. And by the way, vacancy can break out into a couple of things. Concessions that you give, like free rent to tenants, which nobody does anymore, but there was a time when you did. Or whatever incentives you give, or things like that, free gym membership, whatever it costs you, that's all in vacancy. So you take gross effective income and then you subtract operating expenses. And this is everything but debt. So this formula we're calculating here has nothing to do with the mortgage on the property. I don't care if you pay cash. You put 20% down, 50% down, 30-year mortgage, 15-year mortgage, doesn't change. It's always the same. It's a measure of the property's performance. So what's in operating expenses? Taxes, insurance, management, repairs and maintenance, utilities, services, garbage, cleaning, whatever. Pretty much everything but the mortgage. Make sense? Now, in a building that's fairly large, you're going to have accounting, you're going to have legal, etc. So there's a lot more to it than a single-family house. And when you subtract all those operating expenses from the gross effective income, you get NOI. What does NOI stand for? Net operating income. That's the magic number you're looking for, the NOI. Now, is the net operating income relevant or related to the mortgage on the property? No. Nowhere we haven't dealt with the mortgage on the property. If we take the NOI and subtract your P&I payment on the mortgage, then you're going to get net cash flow. And that is dependent on the mortgage. Depending on what interest rate you have and what term, whether it's adjustable, that all goes into net cash flow, but NOI has nothing to do with it. So we need these two numbers to plug in, NOI and net cash flow. Okay? And that brings us into the 4 commercial formulas. The first is what's called cap rate. This is just simple math, simple algebra here. Take the NOI, divide it by the purchase price, and remember this is annual, not monthly NOI. Annual NOI, divided by the purchase price, and you're going to get what's called the capitalization or cap rate. How many people have heard of that before? So cap rate, that's your cap rate. Now remember, this is not as is, this is best case. So we're looking into the future, what should this be? Okay, and based on that, I can come up with a number. So let's say, you have to know what the going cap rates are for that type of property in that sub-market. So let's say that the going cap rate was 10%, 0.10. That means net operating income divided by purchase price. Let's say you had $100,000 in net operating income and $1 million purchase price. That's 0.10. That meets the standard. So best case scenario, it operates at a 10 cap. Now if everybody else is operating at a 6 cap, and you could potentially get into a 10 cap, you should be looking hard at that. Even though as it stands, it's a 4 cap. That's not relevant. If it can get to the 10 cap, and the market is 7 or 8 or 6, you can sell it and make a lot of money. Does that make sense? Get it performing and then sell it for a lot of money. All right, now, so that's simple. Cap rate is net operating income divided by purchase price. And that's a quick and dirty. If you got like a small apartment building and the seller says, I'm asking $1 million, and you go, what's the NOI? He probably doesn't know what that means. I was like, all right, how many units? 10. $1,000 a month rent each, that's 10 grand a month. 10 times 12 is 120 a year, right? Everybody follow so far? So if the gross is 120, typically the net is going to be half. That's just a rule of thumb. They do the half rule. Remember Richard Pryor? He used to do, when you get divorced, half. Or was that Eddie Murphy? I think it was Eddie Murphy. If you take that 120 a year and divide it by 2, that's pretty close to what the NOI probably should be on a typical older build, 60s, 70s building, B or C class. It's going to be about half. So if you did that, you take 120 divided by 2. What do you get? You get 60. And he's asking $1 million. What's the cap rate? 60,000 divided by $1 million is 0.06 or 6 cap. Is that good? No. And by the way, the building's fully occupied. That's the best it is. He's way overpriced. And you didn't have to pull out an HP 12C calculator, run it through an Excel spreadsheet, or do all kinds of due diligence. You can do that in 10 minutes. It's a good, quick and dirty rule of thumb. Yeah, you have a question?
I had a question kind of applying that to a single family. You use your example.
You don't. You use comps on single families.
Right. But just kind of.
But if you wanted to analyze the cash flow, you can do the same thing.
If you had 10 properties in your earlier example today that were 10 and free, what can you reasonably expect to clear on a percentage basis if you own 10 properties free and clear after all the related expenses and everything you have to contend with taxes, insurance,
right,
repairs, maintenance?
Well, my formula with single families was 1.25 times PITI. If we wanted to do the same thing, we'd have to yank out taxes and insurance, put it in the expense category, and then say 1.25 times just principal and interest. The general answer is, when you go for a loan application, and you say, I make X on my property, what are they discounted by?
25%.
25%, that's your number. That's right on the money. Isn't it? I mean, everything but mortgage, not T&I, but taxes, insurance, management, maintenance, repairs, vacancy, 25% on a single-family house.
I think that's like for median type of normal houses.
Yeah.
The lower it goes, the bigger that number gets.
Sure, sure. But the typical, when banks do that, they just yank 25% because that's pretty much a standard. A standard industry expense ratio should be 25%. So if we go back to our rental formula for the single family, back to our $1,500 a month, if we knock 25% off of that, it's hard math to do in my head, but
375.
that's about 300 off?
375.
How much is it?
375.
375, good math. Okay. So that brings us down to 1125. Now, remember I said my PITI was like 800 or 900? I'm just looking at P&I, which is a lower number. So you end up in the same place. I just did it that way because it's easier to figure out on a single family, because most people have PITI together on a single family mortgage, or in commercial you don't. That's why I separated out on commercial. Does that make sense? But it's the same basic analysis. Now, more units, more expense ratio. So duplex, triplex, fourplex, you're approaching a third. Where you get into like 5, 10, 15, 20, 30 units, it's half. And then what's interesting, once you get like over 150, it goes back up again to like, it goes down again to like 45 because of efficiencies of mass operation. You have better management, you can buy things at bigger discounts because you have lots of them. So what happens is when you get up around 10, 15, 20 units, 30 units, it's not very efficient. It's about, the expense is about 50% of gross. When you get up to like 200, 300 units, it becomes a lower number. It becomes more like 40, 45% because it's the efficiencies of mass operation. Make sense? It also depends on the age of the building, and how much deferred maintenance. There's a lot of factors that go in.
Sure.
Depends what the landlord's providing. Is the landlord providing heat, electric, air conditioning, a gym, services, so. But roughly half.
Rules of thumb, yeah.
Rule of thumb is good half. So that's one formula. The second formula we'll look at is cash on cash, which is the net cash flow. That's NOI minus your mortgage payment gives you net cash flow, divided by your cash invested, what you put out of pocket. So that's your down payment, your due diligence, your closing costs. That's your denominator. That's an accurate measure of what money you're making on your money annually. So that definitely depends on what the interest rate of the loan is, if it's amortized over 15, 20, or 30 years, and so forth. Don't worry, I'll go through this in the morning again so it's fresh in your head. The third one is the average rate of return. Now, if you bought it at a super price because it needed work or it had problems, is the cash on cash recognizing that equity? If you build an equity, or if you have future appreciation, does cash on cash measure that? It does not. It just measures how much you put in, how much you're getting back every year. Now, if you never sell it, then that's as far as the analysis goes. But if your plan is, I'm going to turn this thing around, I'm going to get a certain amount of cash flow for 5 years, then I'm going to sell it, I'm going to get a chunk of cash at the back end, because I'm paying down the mortgage now, I'm building equity, it's appreciating, I got the thing performing better, so it's worth more, so you're going to get a certain amount of cash flow each year, which is your cash on cash return, and at the end you get a chunk. So what do? Take all the cash flow you got for those 5 years, add it to the chunk, right? And then divide the whole number by 5 years, and then do the same analysis, and you'll get your average rate of return over the life of the investment. Does that make sense? And that's usually a higher number. It better be. If it didn't, you paid too much for the property. Does that make sense? So just like with a single family house, like I'll give you a more simple example so you can follow this. It's sort of hard to get your brain around without the math involved. So let's say you had a condo that you paid 50 grand cash for. Okay? And let's say you made $5,000 per year net cash flow. So minus all the expenses, net cash flow. Okay? And you did that for 4 years, which means you pocket a total 20 grand cash flow. Make sense? So let's say after 4 years, you sold it for $70,000. Forgetting about broker's costs and all that stuff. So what did you net? You paid 50s and you sold it for 70s, so what did you net? On the back end. 20, right? Bought it for 50, sold it for 70, you netted 20. So all in all, what do we have here? Well, you put 50 up and you got $5,000 a year. So what was your annual return on your money? 5 divided by 50 is
10%.
10%, right? But after 4 years, you got another 20 grand. So over 4 years, you got 20 plus 20, which is 40. So we take 40 divided by 4, and what did you average a year?
10.
10 grand over this life of this investment. So what's 10 grand divided by 50?
20.
20%. So what was your average rate of return over the life of the investment?
20%.
It was 20%. Just do the same thing but bigger. Okay? Now, that's one measure. The only reason I did that was because it was easy to figure out. The real number is what's called internal rate of return. How many people have heard that before? The IRR. I would draw the formula, but I would miss up your screen. I can't draw the formula. It's got a sigma in it, and I don't know what that means, because I never got past first year calculus.
Is that what Matt Damon did in Good Will Hunting?
Right. It's like a Matt Damon in Good Will Hunting, that's right. He's just all over the board. Basically, conceptually, think about it this way. Did you really you got 20 grand later. Is 20 grand later the same as 20 grand now?
No.
No. What do you have to do to figure out what 20 grand is worth now that you get later? You have to discount it to its present value. So that's what the internal rate of return. You take the average rate of return and discount everything to its present value, which is a slightly lower number than average rate of return. Does that make sense? That's the magic number. You can't calculate it with a calculator. But there's plenty of spreadsheets you can buy and software you can buy that'll calculate that. But it's still going to be a much higher number than the cash on cash. Does that make sense? That's the internal rate of return. So have you ever heard of the internal rate of return? It's real hard. Average rate of return you can do on a calculator, but internal is very difficult. Just typically, depending on how long the period is, if it's only 4 years, it's probably like 10% less. If it's like 10 years, it's more, because the longer it goes out, the lower the internal, because the discounting into that present value. Just so take average and take a smidgen off of it.